Okay, so in 2025, the banking giant HSBC didn't just have a good year, they absolutely crushed it, shattering their own records. We're going to break down exactly how they did it, talk about the massive strategic bet they're making on Asia, and ask the big question: can it protect them from the economic storms on the horizon? So let's dive right in. First up, the headline number that really says it all: a jaw dropping $36.6 billion in profit before tax. And look, this wasn't just a little bit of growth. This was a brand new peak for the bank. It literally made 2025 its most profitable year ever. And it wasn't just about the raw profit either. The efficiency was, well, just as impressive. They delivered a 17.2% return on tangible equity. For a bank of this massive size, that is a ridiculously high performance number. It just goes to show they're generating fantastic returns on their core capital. So, how did they pull off this record-breaking year? Let's take a quick look at the scorecard. Right, so it's one thing to hit your own targets, but they were also just demolishing what the market expected. I mean, take a look at the fourth quarter. Their earnings per share hit $1.85, completely blowing past what the analysts predicted, which was $1.60. That is a crystal clear sign of a company that is just firing on all cylinders. And all this amazing performance, well, it translated directly into returns for shareholders. The bank announced a full-year ordinary dividend of 75 cents per share. That's a 14% jump from the year before, a really powerful signal of just how confident they are in their financial strength and what's coming next. But what's the actual strategy behind these incredible numbers? Well, it all comes down to a brand new game plan, one designed to make this banking giant simpler, faster, and a whole lot stronger. The group CEO basically laid out three core pillars for their strategy. First, become a simpler, more agile bank. Second, really sharpen their focus on the customer. And third, deliver growth that isn't just focused, but is actually sustainable for the long haul. And hey, this wasn't just a bunch of corporate buzzwords. They backed it up with some pretty aggressive action. They delivered $1.5 billion in savings ahead of schedule. They got out of 11 different markets or business lines. They trimmed down their senior management by about 15%. And then they took almost $2 billion from low-return areas and plowed it into higher growth opportunities. Real moves. The CEO, Georges El-Hedary, he summed it up perfectly. He said, "We are creating a simple, agile, growing bank built to generate high returns." Simple as that. Now, this whole strategy of simplifying things globally, it allowed them to make the single biggest move of the year. A massive, concentrated bet on the bank's historic home turf of Asia, and more specifically, Hong Kong. So what was this incredibly bold play? Well, it involved taking total control of a key subsidiary, a move that really reshapes its entire presence in one of the world's most critical financial hubs. The move was the privatization of Hang Seng Bank. So what does that even mean? It means HSBC, which already owned a big chunk, went out and bought all the remaining shares to take the subsidiary completely off the stock market so they could fully integrate it. Okay, the financial gymnastics behind this deal are just fascinating. The purchase price was a pretty hefty $13.7 billion. But, and this is the clever part, by fully bringing the subsidiary in-house, they unlocked almost $4 billion in capital that was kind of trapped by regulations. This instantly cut the net cost to their core capital down to under $10 billion. And what do they get for that? An estimated $1.3 billion, or maybe even more, in annual profit. That's a trade they were clearly very happy to make. The whole goal here is to become what they're calling a super connector. By pulling Hang Seng Bank in completely, HSBC thinks they can unlock almost $1 billion in synergies, really cement their leadership in Hong Kong, and just fully take advantage of the city's unique role as that financial bridge between mainland China and, well, the rest of the world. So, with this massive power play now complete, what does the future actually look like? Let's take a peek at HSBC's ambitious targets for the next 3 years, and maybe, just maybe, the headwinds they're already getting ready for. Their ambition is frankly crystal clear. They're targeting a return on tangible equity of 17% or better for 3 years straight, a level, by the way, that a lot of their competitors would be lucky to hit even once. And it all culminates in revenue growth hitting 5% by 2028. That's a bold plan. But ambition, it always has to face reality. And the bank is being really upfront about the risks on the horizon, especially when it comes to credit and the quality of their assets in their core market of Hong Kong. Specifically, they are watching Hong Kong's commercial real estate market like a hawk. They've already warned about a higher charge for expected credit losses next year and have pointed to almost $2 billion in higher-risk property loans. The good news? They've already set aside nearly $1 billion in provisions against that. They can clearly see the storm clouds, and it looks like they're preparing for them. So it really all comes down to this. HSBC is making a huge bet on a leaner global operation and an even deeper focus on Asia. The performance so far is undeniable, but so are the risks. The big question we're left with is, will this sharp, new, focused strategy be enough to navigate the economic turbulence that just might be waiting right around the corner?